Mr. Starkman is the managing editor of The Audit, which is an online project of the Columbia Journalism Review, and he has won many awards in journalism, including leading a team that won the Pulitzer Prize. And his most notable work has been The Watchdog That Didn't Bark, the disappearance of investigative journalism. We're going to move a little bit away from pure finance here to have another perspective, the perspective of the role of media and journalism in the crisis. So hopefully we'll all learn a little bit about this sector, and we thank Mr. Dean Starkman for his time.
I'm really excited to be here. I want to thank Diego Cook and Michael Bellini and Jaime Moran and all the organizers of this summit. First for bringing me here, but also to congratulate them for holding this summit at all, and particularly to make the crisis the centerpiece. You know, if you read their blurb about this, I literally couldn't have written it better myself. They want to this is on the summit's website, to capture and summarize a phenomenon that started in the financial sector and spread throughout the economy and infected every part of society like a virus. We believe the crisis marks an unprecedented turning point in society in the history of modern capitalistic society. This complex event and its consequences will continue to be studied for many years and will continue to transform our society. We are living through them, and we don't want to wait 20 years to understand them. Again, I couldn't have said it better myself. And my business is basically financial journalism, which has moved on so fast from the financial crisis that it would make your head spin. And yet, most of the rest of us, and including most of the rest of the world, is still living with its consequences. So, the title of my book is called, as Diego said, it's called The Watchdog That Didn't Bark, The Financial Crisis and the Disappearance of Investigative Journalism. And it's not meant to be subtle, and obviously I'm describing what I see as a fairly significant media failure, which I'll get to. Oh, and just to sort of give you sorry, I tend to walk around a lot. Any one of those mics that like Madonna wears or something. But this is going to be as much about journalism as it is about finance. And I'm going to, I guess, challenge you to think and listen, not necessarily only as business and finance students, but as citizens. People who vote and have to, through voting and other means, exert some influence over policy, including in the financial area. In any case, the book was published in January, and I've had a few months to reflect on it. And the more I've thought about it, the more I thought about this as a problem of information when I talk about a journalism failure. And so I'll go to, this is the first slide. I came across this story a couple of months ago. It says Geithner among Fed losers in 2008, Dudley among winners. Geithner, of course, is Tim Geithner, who was president of the New York Federal Reserve at the time. Dudley is William Dudley, who was on the chairman of the Open Markets Committee again at the time. These are prominent Fed officials. And what the story is doing is it's reviewing the minutes that were recently released from the Federal Reserve during the moments of the Lehman crisis. And so for the first time, we got a view of what the Fed officials were talking about during this very tense time. And of course, while William Dudley was among the winners and Tim Dudley was among the losers, what we learned from reading the story is that nobody really knew much of anything. They were all sort of groping in the dark. And what's significant about that, of course, is like we're not even talking about the public or even journalists. We're talking about people at the very epicenter of the financial system. essentially being in the dark about what was going on in key markets, particularly the subprime market. Now, I don't actually have a, whoops. Oh, and when you talk about losers, this would be the biggest loser of them all. This is Alan Greenspan, who, it should be remembered, wasn't just chairman of the Federal Reserve, but he claimed and actually did have particular expertise in housing. Alan Greenspan is an expert in the housing market and was a voracious consumer of information and data about it. And yet again, he also didn't know. What was interesting was you go back and look at the literature of the period, as I've done. Oh, and I just wanted to I think I'm making an obvious point. I think all of the panelists would agree that, or I hope there's a consensus at this point, that the financial crisis started if it wasn't utterly centered on the subprime mortgage market in the U.S. in the U.S. housing business. Yes, we can argue about this later, and if there is any argument. But anyway, I can't resist reading this funny quote by a investment manager describing what happened in this market. I think you're all fairly familiar with securitization, in which mortgages are packaged together and sold as securities, and then derivatives are made on top of those. Here's how it's described. You can turn a whole bunch of chickens into bundles of chicken parts of ascending quality, from gizzards to breasts, and charge a premium for the best cuts. The butcher gets paid, and the shopper gets what he wants. The problem was, eventually, that gizzards were packaged as breasts, and then there was salmonella. That's a little finance humor, people. But actually, it's a little bit misleading. In this description, the line you're seeing that goes up to 23.5% would be gizzards. But in fact, most people would agree at this point that was actually the salmonella itself. That this wasn't just a poor quality product. It was actually defective from the get-go. And I think it kind of goes without saying that this is just a chart of the derivatives that were made on top of those bad mortgages. Those are collateralized debt obligations. We don't have to get into the technicalities, but we're here to talk about the global financial crisis. And this is sort of the beating heart of it. Okay. So what I noted as I went back through the literature was that while even people at the epicenter of the financial system with access to the most, one hopes, up-to-date information didn't really have a clue about what was happening in the markets, there were people who did know. And many of them were, some of them happened to be journalists. And the trouble was that most of these journalists didn't work for the mainstream business press. There's a few things that you come across when you go back and read. There was a 6,000-word piece published in a small periodical called Southern Exposure, and it included this paragraph. A seven-month investigation by Southern Exposure has uncovered a pattern of predatory practices within Citigroup's subprime units. Southern Exposure interviewed more than 150 people, borrowers, attorneys, activists, current and ex-employees, and reviewed thousands of pages of loan contracts, lawsuits, testimony, and company reports. The people in the documents provide strong evidence that Citi's subprime operations are reaping billions in ill-gotten gains by targeting the consumers who can least afford it. And the date of this publication was summer of 2003. This is before the party even got started really in the subprime market. And then there was this book by a fellow named Richard Lord. Now, who's Richard Lord? He was an urban affairs reporter for a newspaper called the Pittsburgh City Paper, alternative paper in Pittsburgh. He wrote this book, American Nightmare, Predatory Lending and the Foreclosure of the American Dream, which, among other things, described some of the practices that I've referred to, but also was able to trace the problems in these mortgages to its funding source. And the funding source for the subprime mortgage industry was, of course, Wall Street. So he wrote this. By its very nature, the mortgage-backed securities markets encourages lenders to make as many loans at as high an interest as possible. That may seem a prescription for frenzied and irresponsible lending. But he says, he writes, I'm paraphrasing him, but there were characteristics of the prime market that held those problems in check. Basically, the prime markets, plain vanilla products, 30-year fixed mortgages, and a market of fairly sophisticated borrowers who have other choices. But he says, but those breaks don't apply as well in the subprime lending market, where regulation is looser, marketing more freewheeling, and customers less savvy. All those three last statements are enormous understatements. But the date of this book was December 2004. Again, we know the mortgage crisis really got going in 2004, 5, and 6. He was basing his reporting on material he had seen in inner cities in Pittsburgh, in Newark, Chicago, and elsewhere in 2002, 2003. The point here, of course, is that there was something going on where one kind of information was available in great quantities to people at the elite level, and yet it was essentially they were essentially left without any real sense of what was happening, whereas other people did have that information, and we have to sort of think about what this is all about. So why did I write this book? Well, the short answer, of course, is that the financial crisis, and it had several elements we need to think about. One, that it was obviously catastrophic. That's why we're all here today. Secondly, it was entirely man-made. Third, it was on a central beat of American journalism. And fourth, it came as a complete surprise to the public, the press, and indeed, as we said, the financial sector itself. So, sorry, I just got these new reading glasses. I have to pull them on and off, but I'll get used to them. So I wanted to explain what I saw as this failure of journalism and put that failure into historical context. And the idea was I was trying to do something fairly ambitious, which was to provide a sort of a new frame for reading the news, both for journalists and for non-journalists alike. The journalism problem I was looking at is not new, but it goes back to the very origins of American journalism in the early 20th century. So why am this book writes about this lady. Her name's Ida Tarbell. If this was a journalism group, many of them you would know her, but actually quite a few wouldn't. Ida Tarbell was one of the great muckrakers of American journalists. This is a group of journalists who rose in the early 20th century who wrote exposés of business, government, and labor and other problems in American society. And why would I write about her? Well, the answer is that she faced the exact same journalism problem that our contemporaries faced in the mortgage era, and that is, how do you explain a complex problem to a mass audience? In her day, the complex problem was monopoly, industrial consolidation, when major industries were basically controlled by what we would now call oligarchs. She took on the oil industry, John D. Rockefeller's Standard Oil Company, and what she did was she basically had to create an entirely new journalistic form in order to tackle this problem. Now, why are the muckrakers so important to us today? Well, they actually they had several traits that I think are quite important and left a legacy that our contemporaries sometimes forget. They had a certain journalistic purity. These were not activists or partisans. They had no political axes to grind. They were really great. Actually, they were just journalists, great storytellers. They had a journalistic ambition that was very sweeping by today's standards, and they combined the Victorian era's faith in science and a scrupulous fidelity to fact-gathering and gathering true facts with an unabashed moralism. As moralists, the muckrakers recognized the importance of human agency and didn't shrink from holding power to account by name. And they crafted what could be called America's only true ideology, and I would call that an ideology of anti-corruption or anti-lawlessness, when there were real problems either in urban corruption or in business corruption, as there was in the Standard Oil case, or in labor unions. They went in and exposed it. And they sort of left us a real legacy that I think we need to think about when we're talking about reporting today. Now, what I did was also I juxtaposed this style of report. And by the way, the history of the Standard Oil Company was a 19-part expose. It was essentially created a national sensation. It increased the circulation of the magazine she wrote for by 100,000 to greater than that of the New York Times would be today. And it was essentially was credited with sparking the antitrust case that eventually broke up the Standard Oil monopoly in 1911 by the U.S. Supreme Court. And what was interesting was, at the same time that this form of journalism was happening, was emerging, another was also emerging at the same time. And that's the form that we conventionally think of as business journalism. At the very same time that she was writing, there were people named Charles Dow and Edward Jones and others combined to form a company called Dow Jones, which later became the originators of the Dow Jones Industrial Average, and they eventually became the publishers of the Wall Street Journal. What was interesting about this form of journalism is that they're essentially what you have to think of them as sort of a messaging service. They literally were wire services placed in small shops near the New York Stock Exchange. And what they did would be they would ferry information from corporations back to the market and back and forth, primarily using young messenger boys to run them back and forth. And speed was a very important function. And the difference was that one form, this particular form of journalism was it didn't really cover the financial system. It was actually a part of the financial system. So when you think about it, there were these two forms of journalism produced. Both were important in their way, but they produced radically different representations of reality, of the news. Their functions were entirely different. And I'd argue that, and so the two main aspects of business journalism in its early days, the two most important traits of it were speed, as I've mentioned, and also trying to gain access to important, powerful people who would give you information about what was going to happen, whether it be a dividend or what the earnings were, or whether it be a merger. These were two vitally important functions. Business journalism is very important for markets, but again, it's very limited in scope. And I'd argue as we go forward, you'll see that this sort of self-definition is extremely limiting in terms of what business journalism can and will report. So what I want to do is fast forward. So I mean, the short answer to the question, what happened, right? What happened in the U.S. press prior to the meltdown of 2008 was that there wasn't, of course, the short answer is there really wasn't an Ida Tarbell looking at doing a sprawling expose about financialization and problems in subprime. But the longer answer, of course, is we have to think about this. Of course, we know that business journalism was very busy during this period, and they produced oceans of copy about Wall Street and mortgage lending. But what was it about? And I think what we need to do is sort of look back and sort of try to understand like what was actually done. So what I did do, I speak with some authority on this topic because I did a project in 2009, and I looked in a systematic way, basically a content analysis of major business publications and their major stories from 2000 through mid-2007, when I think everyone would agree it was the seeds of the subprime crisis were already laid, the mortgages were made, and all of the securities had been sold. and I looked for the best material that would have reasonably be seen as providing warnings to the public and the financial sector. And I found very little. And if you want to Google the study, you can just Google CJR, Columbia Journalism Review, Power Problem, and the database that I assembled is called CJR, the list. You can Google it that way. And you'll see that there was like that stories that really were warning of that could be compared to this were really few and far between. But if you read conventional business coverage, you'd see that not only did it not provide warnings, but if you really look at the coverage of Wall Street and mortgage lending through the conventional frames of business news, you'll see that it actually helped promote and stoke the practices that led to the crisis. What's interesting is you go back and read all the profiles of Merrill Lynch and Goldman Sachs, Washington Mutual and Citigroup. What's interesting about these stories is that they're all factually accurate. And if you go back and read them, as I have, they're actually all a lot of them are quite interesting. These are profiles about the inner workings of these large investment banks. But the important thing to remember is they're also entirely irrelevant to the problem that was about to hit. The information they provided had nothing to do with the subprime market and what was going on, unlike stuff that was being done elsewhere. So let's just take a look, for the argument's sake, at Lehman Brothers coverage. Lehman was one of the, obviously we know its fate, but you'll see that the reading of these stories, I call them profiles, corporate profiles, show that they were so deeply embedded in Wall Street values and expectations that they actually contributed to the atmosphere stoking predatory lending. For instance, in January 2004, you also see how similar the coverage is across publications. In January 2004, Business Week ran a story on the rising fortunes of Lehman Brothers because, as the story said, it was diversifying away from its roots as a bond trading house and into investment banking and other services. The headline proclaimed, under CEO Fuld, the bond house has become a deal-making power. The story starts with an anecdote designed to show how relentless Dick Fuld is. Dick Fuld, of course, the CEO. It was late December, the story starts, but the holidays were not on the mind of Lehman Brothers, Inc. CEO Richard S. Fuld, Jr. In 2003, Lehman had catapulted ahead of a slew of Wall Street rivals to become a serious investment banking power, and Fuld was not letting up. On his desk, next to a tall Starbucks mocha frappuccino, was a list of hundreds of banking clients. He was determined to reach every person by New Year's Day. Quote, "When something is on my list," he says, "it will get done." This is fairly representative of what a business press staple I would call, that I call a corporate profile. It examines investment banks in terms of their competition with other banks, often via carefully negotiated profile of the CEO. This is you do to humanize otherwise fairly dry topic. In October 2004, the Wall Street Journal published a 2,400-word story on Lehman based on a similar premise under this headline: trading up to crack Wall Street's top tier, Lehman gambles on going solo. The headline emerges. The headline goes on to say, the firm built on bonds expands without seeking merger. Investment banking is key. No new gorilla for Mr. Fuld. And the gorilla reference is to a teddy bear gorilla that Dick Fuld had kept in his office as sort of a joke until September 11, 2011, and afterward he got, and when they had to move out of their building, he found a renewed sense of purpose, a renewed seriousness, and so he got rid of the pet gorilla, the toy gorilla. April 2006, Fortune yet another story on Fuld and Lehman, the improbable power broker, how Dick Fuld transformed Lehman from Wall Street also ran to super hot machine. And it starts this way. Consider this. When Lehman went public in 1994, it had only $75 million in earnings, with a paltry return on equity of 2.2%. Fast forward to 2005, and the turnaround is breathtaking. Lehman booked $32 billion in revenue, $3.2 billion in profit, and hit 19.4 in return on equity. Over the past decade, Lehman's stock is up 29% per annum on average, highest of any major securities firm, and 16th best among the Fortune 500. The story aptly notes Lehman's enormous reliance on bonds, which then accounted for nearly half the firm's revenue. Lehman's Fold's magic has in part been to ignore doomsday predictions that Lehman was too focused on bonds. Instead, he chose to exploit that area of strength, building the firm into a fixed income juggernaut and benefiting mightily from the seismic decline in interest rates over the past decade. Today, Lehman derives 48% of its revenue from fixed income. Well, fixed income was a problem. Fixed income is what you call bonds, and bonds are the things that were made out of mortgages. So keep in mind that I worked for the Wall Street Journal for 10 years, and I know that many of the writers that wrote this stuff, and we're talking about a very capable set of people. These are really smart, really engaged, very committed people. And yet, as you can sort of see, there was something missing from this picture. I put this slide up because this is Jamie Dimon, circa 2006 on Fortune. Now, J.P. Morgan wasn't obviously the worst of the actors, but this sort of gives us sort of a sense of when conventional business news focused on a single person or individual, you know, that's sort of the take you got. And here's one that really surprised me. Check the date. October 28th, 2007. And the headline is The Survivor. And that's Dick Fold right there. Now, Lehman Brothers went bankrupt in September 15th, 2008. Now, again, it's not about that this story is factually inaccurate or that it's wrong in any of its particulars. And Lehman was a survivor at that time. But think of you have to kind of know the history of the crisis, but the crisis basically began to unfurl in the beginning of 2007, late 2006. Early 2007, basically by the summer of 2007, basically every subprime lender had basically gone bankrupt or was shuttered. The debt markets were going crazy with Treasury spiking and bond prices for mortgage-backed securities plummeting. Everyone was freaking out about who was holding what on their balance sheets. And the story couldn't ignore the fact that Lehman had an enormous amount of fixed income mortgage-related products on its balance sheet, basically overwhelming amount. But it said, but the bank has positioned itself well. It has been building its long-term capital since 1999. Last fall, troubled by what it saw in the mortgage market, it started to hedge its exposure against the mortgages it was accumulating. What's interesting here is that this paragraph says, troubled by what it saw in the mortgage market. Lehman Brothers was neck deep in the mortgage market. It wasn't some innocent bystander. It owned one of the largest mortgage originators in the country, a country that's now forgotten, called BNC Mortgage. So, and as we'll see, essentially all of the large subprime lenders couldn't have existed without companies like Lehman Brothers, which gave them warehouse loans to make their original loans in the first place, and then bought all of the paper from them and sold it on the secondary market. Essentially, the famous subprime lenders that you may remember or have heard about, Countrywide, Ameriquest, New Century, IndyMac, all of them gone. They were essentially creatures of Wall Street. And yet, we're not getting a lot of help here from conventional business news. So I think as a journalist, this made me stop and think. Now, the whole topic was a problem, a journalism problem. Again, we had an ocean of material being written about Wall Street and investment banks. B, it was written in good faith by really smart people. C, it basically had nothing to do with the problems that were coming. And yet, there was a strain of reporting that was not necessarily, not entirely not in the mainstream, but almost most of it was outside the mainstream, that was totally not only just getting the problem in the mortgage market, but was able to trace it to the problems in the mortgage-backed securities markets and the derivatives that were made on top of them. So I started to think about it, and it occurs to me, I came up with essentially this dichotomy of access and accountability reporting, and this is something for you maybe to think about as you read newspapers going forward. It's the reason I went back to look at Ida Tarbell and her counterparts in the business press, because it struck me that we're looking at two entirely different approaches to the news. Both are important, and yet yet sometimes one doesn't get done. So here's how I describe it. I say these two tendencies represent different journalism subcultures. They rely on different sources, insiders versus outsiders, authorities versus dissidents, top executives versus fired executives. Usually these are whistleblowers. They require different skill sets, like the Access reporter who is trying to get a scoop from John Rockefeller or his cohorts needs to be a fairly diplomatic and skillful sort of political player, whereas the accountability reporter is more of a confrontational practice. They even presuppose different worldviews. Like access journalism might tend to accept institutions and systems as they are and seek to learn their internal goings on. Accountability journalism tends to question institutions and systems. One can be said to transmit orthodox views, the other heterodox. And as they say, the differences can be listed. So when you're looking at conventional business coverage, these are typically stories that the prototypical business story is the merger and acquisition scoop. That's a story about a pending deal that requires highly specialized knowledge and inside information. And so you really have sort of two completely different ways of going about the business of journalism represented by these two approaches. And within American newsrooms, there are perennial competitions between these two different styles of reporting. As I've said, both of these styles of reporting are quite valuable, but one essentially is almost a given in journalism. There will always be reporters and publications who are interested in learning about the thinkings and actions of powerful people and institutions. This is the hard stuff. This is where you're looking at a long, slow process that's a very risk-intensive endeavor to try and call powerful institutions to account on their basic practices. But as I say, while one will be focused on investor concerns, maybe mostly for a niche audience of people who might be interested in investing, the other is looking more at the public interest, external costs, social costs, and speaking essentially to a mass audience and to the public. My point in making this dichotomy is only to make sure that when people are reading the news, that they understand that you can cover something extremely closely, as we've seen in this stuff, and yet miss the point. So, as I say, while it may seem that one is the bad kind of journalism and one is the good kind, that's really not what I'm talking about. It's not the case. You know, it's essential to know what people in power are thinking, and it's not a trivial task to try and find out. Like Bob Woodward, in his post-Watergate days, has been criticized as being an access reporter who gets powerful people in Washington to talk to him. And critics call it a trade in which the great grant access in return for glory. And one of them said, access is all, analysis and criticism are nowhere. Yet most people, even the most severe critics, acknowledge the value of getting this kind of information, the information that Woodward brought about the Bush administration, while it was slanted toward the administration's worldview, nonetheless added a lot to the historical record. So, and neither is access reporting synonymous with flattering or favorable reporting. In fact, they sting powerful people in their reporting as a day-to-day practice. But what marks access reporting is its closed loop of sources, its top-down nature, its lack of interest in systemic problems. So it tethers itself to the never-ending flow of news, events, and access reporting allows powerful institutions to set the public agenda, to define what's news. Most of all, you could say that access reporting is defined by its insularity, an insistence on looking at its subject through frames set by the institutions on its beat. In business news, the access frame can be widened to focus on investor interest, but it still doesn't represent really the public interest. And that's the difference. So during the mortgage era and afterward, this insularity of access reporting, its reliance on elite sources, its echo chamber qualities hamstrung, I think, business press coverage of mortgage lenders in Wall Street. This incremental approach to news gathering seriously impaired the business press's ability to detect essentially what was corruption in the mortgage market and aftermarket, and its insider focus was fatal. Now, when I think about the difference between these two types of practices, to me it's the difference between information and knowledge, or data and knowledge. Information is something that can be put to pragmatic use, and knowledge is sort of a deeper form of understanding. So, does all of this matter, and does journalism matter? And that's actually a point you'll be I hear a lot, and does anyone care? Does anyone read it? Is there really a watchdog? And there's a surprising number of people, and maybe some in this room, but there's a surprising number of people who do say no. It doesn't matter. I got a review actually last week. He's taking me to task on this very point. You could say it was a relatively negative review. The first 5 words are the fundamental failure of Dean Starkman's. So he says that the fundamental failure of Dean Starkman's The Watchdog That Didn't Bark, the financial crisis, disappearance of investigative journalism, and of mainstream journalism more generally, is hidden in plain sight in the title's metaphor. Starkman explains why journalists often aren't alert watchdog, but he can't see why limiting the profession to the role of a barking dog is quite literally a dead end. This is the writer's Robert Jensen. He's a professor at University of Texas. Turns out he's a Marxist, anti-capitalist, and he's calling me to account on from that perspective. And actually, it's actually rather valuable, but it's also, I would say, in reply to him, a dead end. He says this: journalists should report on abuses by the powerful, of course, but within what underlying analysis of the larger system? Are illustrations of these failures used to deepen our understanding of the unjust and unsustainable nature of a capitalist system? Starkman doesn't take up the question, but his answer seems to be no, since he expresses faith in, quote, effective journalism and uncompromised regulation, which, quote, operate independently but together create a dynamic that generates information, public awareness, and ultimately reform. That seems to be where the process stops for Starkman, fine-tuning reforms. Now, I would argue that journalism matters for its own sake, and that the greatness of, for instance, Ida Tarbell's work on Standard Oil wasn't that it necessarily led to the breakup of Standard Oil or created other kinds of antitrust reform, but it was that it offered a clarifying insight to the public about a complex problem. And it allowed the public into the discussion about the leading economic problem of its day. That was the value of this kind of watchdog reporting. But I would even go further than that. Because particularly in business, as you'll find out, and in finance in particular, and in the subprime market even more so, reputational issues are critical. These firms are acutely sensitive to the effects of negative publicity. And I'm going to show you so in my book, one of the reasons I wrote this book, it's called The Watchdog That Didn't Bark, and it presupposes there's such a thing as a watchdog. So I had to spend half the book basically making the case that actually mainstream reporting, since Tarbell forward, could actually be an effective watchdog. It just, for reasons we can get into later, it just didn't happen to assert itself during the mortgage era, quite tragically. And if you go back and look at the record, what's actually surprising is to see how often abusive and rogue lending operations were actually called to account and policed to a great degree by newspaper reporting. And there's a whole string of cases, but let me just give you one. There's a story in the New York Times, and it was actually an amazing expose in the New York Times, and in combination with ABC News 2020 program, they did a joint venture, and they wrote about a subprime giant named First Alliance Mortgage Company. It was based in Irvine, California, and it started with a lead about a woman who had been hoodwinked by the company. Her name was Gunderson, and it goes and says this. The Gundersons are amongst scores of consumers who have complained to state regulators about First Alliance, a national home equity lender based in Irvine, California. More than a dozen homeowners have already sued. They all assert that the company has used a deceptive sales pitch delivered by loan officers recruited from big auto dealerships to lure homeowners into high-cost loans that expose them to the threat of foreclosure and financial ruin. And it goes on and so forth. It talks about all the regulatory trouble that this outfit, First Alliance, which was basically the Countrywide of its day, was involved in. And then it says, but First Alliance has some very important supporters. The investment banks on Wall Street that help it raise the money lent to people the money lent to people like the Gundersons. These banks began raising significant amount of money for the company in the early 1990s, after it had already come under investigation in California for discriminatory lending. Excuse me. An investigation by the New York Times and the ABC News program 2020 shows they have pumped hundreds of millions of dollars into First Alliance in recent years, even as civil lawsuits and state investigations have raised increasingly troubling questions about First Alliance's business practices. The money raised by Wall Street for First Alliance and dozens of similar companies has financed a quiet revolution in the financial habits of millions of Americans whose low incomes or blemished credit histories otherwise prevented them from obtaining conventional loans. Such subprime borrowers, as they are called in the lending industry, have turned in increasing numbers to finance companies that cover the risk of default by charging them significantly higher fees and interest rates. Okay, the date on this story is March 15th, 2000. And again, it was one of the last stories of this type that appeared in the years leading up to the mortgage crisis. Again, it's not really time to get into the whys and wherefores of that, but there you go. Look, there's nothing wrong with this stuff. And there's nothing wrong with this. But if you want to know what's coming in the mortgage markets, you're not going to learn it from this stuff. You just won't. That's why we had to kind of figure out, how to think about this stuff, and why, again, why accountability reporting disappeared during the period is a fair question. But that it disappeared is not debatable. That's just the record. And the thing that I'd say to Robert Jensen, the University of Texas critic, who actually wrote a great review. It's just scathing and negative in many ways, but super smart from his perspective. But what I'd say to him is that if you think investigative reporting and accountability reporting leads to, quote, fine-tuning, that's exactly what rogue operators in the banking industry and on Wall Street would like you to think. Because in fact, the result of the New York Times ABC News expose was basically an earthquake. There were, within weeks, the Clinton administration moved to close a loophole in an older law that allowed mortgage lenders to opt out of state laws in favor of easier federal ones. The same month, 4 bills were offered in Congress, including something called the Predatory Lending Consumer Protection Act of 2000, which would strictly limit points, fees, balloon payments, and credit insurance and other stuff that these companies would lay on. Soon, there was afterward there was a series of bills introduced in states and cities around the country trying to curb abusive lending practices. As a one trade publication put it, more jump on the predatory bandwagon. Now, among the people who felt compelled to speak up was Alan Greenspan, then at the height of his influence. And he gave a speech denouncing predatory lending to a group of housing activists. He said, "Discrimination is against the interests of business, yet business people too often practice it." He announced the start of a task force that would study how to define problems in the subprime market. And it was the first time the Fed chairman ever spoke about it, and it was the last. But even more than all of this, right? Even more of this regulatory activity that resulted directly, from this one expose, the market itself was basically walking on eggshells after this. There was a piece in a trade publication called Investment Dealers Digest. Headline was this: "Predatory lending fracas. Wall Street comes under scrutiny in the subprime market as liquidity suffers and regulation looms." Liquidity suffers, meaning that the market for mortgage-backed securities backed by subprime mortgages was drying up. This is, again, June year 2000, right? And it quotes an investment banker, a managing director at Lehman named Rob Little. "Obviously, predatory lending is a high-focus item. People are very cognizant of it, and they're very cautious in terms of how they address it." So in other words, with the help of public pressure, subprime lending, the sector that would be at the very epicenter, right, of our crisis, was being contained. The public was very much in on this problem at the time, and both the problem of subprime and where it came from. It's the sponsors on the street. And so whatever happened to First Alliance, it closed its doors 8 days after the story ran. So that's my answer to Jensen. The fact is that, again, the financial sector is particularly, to say, A, that there wasn't a watchdog, both is historically inaccurate. I mean, there's plenty of examples to be found of it. To say there isn't a watchdog, and then to say that the watchdog is ineffective is also just untrue. I'm not saying it's going to save the world. I'm not even going to argue that it would have journalism could have prevented the financial crisis. But I think if you sort of think about it, first of all, how is the public ever going to find out about a complex problem a problem as complex as the financial system without journalism. I just don't, there's no other way. So that's why we have to sort of address this journalism problem. And without public knowledge, there's no public involvement in this activity. And two, you know, the record's fairly clear that once the public is engaged in an issue, it may not be able to solve it, but at least, again, it would have a chance to address it. In our case, in this case, September 15th, 2008, everyone was groping in the dark. And that's sort of the main problematic that I think that led me to sort of think about this, and why some people knew and some people didn't. Now, I want to close by talking about the now. So we've talked about the financial crisis and its relation to journalism. And so the question comes up, so now what? How are we doing? And is journalism up to the task of confronting the next thing? Whether it's, I think it was Sean, you mentioned global warming this morning, or some other complex problem that we're going to need to deal with. And so I would say that our the answer is no. It's not. That's a joke. I'll tell you next time. But here's the picture going forward. What was interesting about this period after the financial crisis was it was an interesting time to both obviously look at the financial system, but also to look at journalism itself. Why? Well, because first we had this meltdown on a central beat of American journalism, and there's no beat covered more closely than Wall Street in business news. And secondly, it was a period when, I think you're all aware, the very underpinnings, the financial underpinnings of business, of the journalism business itself, has been seriously eroded, if it's not collapsing entirely. I think you're all aware that the search companies, the internet companies, have essentially gutted the revenues of most news organizations, business news and news in general. The stats sort of look a little bit like this when you look at, basically the arrows point in that direction when you're looking at print advertising, circulation, and newspaper and magazine revenues generally. So what we're looking at here is basically a lot fewer boots on the ground in terms of who's going to be covering the news and who's going to be able to dig deep into complex problems. Now you could say, well, what about, yes, but the newspaper industry is like, that's an industrial age business. What about these exciting new digital operations? Aren't they going to fill the gap? And the answer is, it doesn't, I hope so, but it doesn't look like it, at least not for a while. The number you want to look at is for-profit digital. This is the 60 billion, essentially the news business is about a $60 billion business, not the biggest business in the world, but not the smallest. And you'll see that daily newspapers still make up the enormous majority of the revenue, and most of the rest of it is traditional media, old legacy media. The for-profit digital is quite small. And here's where the journalists fit in. There is you'll notice again that legacy media makes up by far the majority of employment among journalists. 4% is by of companies greater than 4 employees, and if you look at the top 30 digital-only news organizations, those would be Huffington Post and BuzzFeed and Vox Media. Help me, you guys are more up on this than me. But the top 30 digital entrants employ 33,000 people. So these are small outfits, and their growth actually is these are not none of the 4% there who are media companies greater than 4 employees. I don't think any of them can be seriously put in the category of financially stable, and so that's sort of our picture. Now, I don't mean to be. I don't want to end entirely on a downbeat. So I will say this. I deal with there are your counterparts in undergraduate and graduate schools of journalism are they are a very promising group, like you guys are in your field. People are still jamming into the field with a real sense of purpose, and there are a lot of very committed people who are working very hard on solving this problem. The internet is not have been a particularly friendly environment for fact gathering and for journalism. We know that, but that's the internet today. Now there have been a lot of, first of all, the newspaper businesses. We're at 38,000, but it's stabilized. That number, that line's basically going flat now, and the panic time is over, and now it's a time for people like you who might be interested in going into the business side of media to help solve this problem of generating enough revenue to make news organizations commercially viable. So with that, I think I'll close, but I thank you for your attention.